With the most recent stock crash and the pullback that already started since mid-February, there are a lot of opportunities out there for long-term investors. Now, of course, a lot of opportunities means that as an investor, you will have to pick and choose. We don't have a limited amount of cash, so we have to pick and choose the best names out there for the long term. Now, usually we do talk about big tech companies, semiconductors, fintech on this channel. Now, today I want to switch it up a little bit, so we're going to talk about companies in different industries. Now, of course, as you know, not here to waste your time, so here are the 4 stocks. I do hope you keep watching, and if not, at least leave me a like and a comment and subscribe to the channel. And yes, I know, quite strange names that are popping up on your screen right now. But I'll explain throughout this video why I picked these names. Of course, this doesn't mean that these stocks cannot go lower in the short term. We're talking here about long-term opportunities. So without further ado, hit all the buttons, especially the subscribe button. We're trying to reach 90,000 subscribers. So if you're new here and not subscribed, hit that red button. It's free. You can always unsubscribe later. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. And also special thanks to FinChat. You can get 15% off if you use my link down in the description and in the pinned comment below. More on them a bit later. Alright, so first up, let's talk about LVMH, one of the oldest and biggest European companies out there. You can buy it in euros, you can also buy it in dollars. It has a market cap of 264.6 billion euros. And if you look at the drawdowns in the last 3 years or so, right now, we are well down 41.2% from the peak. Now, if we look at the year-to-date performance, we are down, well, close to 17% or so. If you look at the PE, trailing 12 months, 21.1, next 12 months, 19.4. So definitely not on the expensive side anymore. Looking at the expected growth rate revenue-wise, 2 years out, 5.5%, EPS 10.6% during that same period of time. Free cash flow margin right now sits at 16.8%. Now, of course, with LVMH, tariff-wise, yes, they could definitely get hit hard. And despite that, despite also, well, their exposure to the Chinese economy and the Chinese market, I am putting it on the list because it is a company that has, well, existed for a long, long time, and it kept growing and growing. Now, of course, in the short term, the business can get hit. We don't know what's going to happen in the short term. For long-term investors that always wanted to open a position in that company, but always said, okay, it was maybe too expensive, because even if we look at the close to 10-year mean here, well, we are cheaper than before. But of course, the business is also, let's call it, struggling a little bit. Not much, a little bit, because of that Chinese exposure. Now, if we look at the expected growth for free cash flow, we've seen revenue, we've seen EPS. Free cash flow is actually expected to get hit in fiscal 25. Then it's expected to grow 8.1% in fiscal 26 and another 11.2% in fiscal 2027. Now, last quarter, they only report twice a year. So the last time we got this report was back in January, end of January. So they tell us here the revenue by region. France is only 8%. Europe, excluding France, is 17%. United States is 25%. So yes, if they do get hit by high tariffs, it could definitely impact their business. Now, remains to be seen how much of an impact that will be. Remember, it's a luxury goods company, so people that do like to spend a lot of money on, well, whether it's wine, cosmetics, watches, etc., I don't think they would mind paying a little bit more. But we'll see. We'll see what happens. Japan is 9%, Asia excluding Japan 28%. So again, that exposure to those markets is something we have to take into consideration. Now, what they did tell us in January is this. Europe and the United States posted growth on a constant consolidation scope and currency basis. Japan saw double-digit revenue growth. The rest of Asia reflected the strong growth in spending by Chinese customers in Europe and Japan. So a bit of what we've seen also 6 months prior. And we'll see what happens, and we'll see how that continues. But all in all, I'm putting this on the list because it is becoming cheaper and cheaper as that stock comes down. The business as a whole is still a tremendous business. Great management there as well. As I said, they generate revenue through various segments, various businesses. So wine and spirits, fashion and leather goods. That's the biggest segment here, which has come down year over year. Perfume and cosmetics has grown a little bit. Watches and jewelry has come down. Selective retailing continues to go up. And then you've got this small part here, other activities and eliminations from revenue. If we look at the profit from recurring operations here as well, the biggest segment is fashion and leather goods, and that has come down year over year. Same from wine and spirits, perfume and cosmetics, watches and jewelry, and selective retailing is actually flat-ish year over year. Zooming out a little bit, if we look at gross profit margin, free cash flow margin, gross profit margin has been around the same levels, although ups and downs, sometimes a little bit more up than down. 67% was the 2024 number. That's down from 68.8% in 2023. When you look at free cash flow margin, we did go up quite steadily. We reached that peak here back in 2021, close to 25%. Then that did drop in 22, 23, but we saw a rebound here in 2024 back to 16.8%. Moving on to company number 2, and that's one of my only winners this year, and that's Alibaba. Now, Alibaba still is year to date up 36%, has a market cap of 264, close to $65 billion. Now here, despite it being up 36% year to date, PE wise, even if we look at the trailing PE or the forward PE, it still is very, very cheap. Now, revenue growth forward 2 years here sits at 6.9%. EPS growing a little bit faster than that at 9.4%. Now, here as well, you might ask yourself, are you crazy? Are you putting Alibaba on the list after what we've seen in the last couple of days? Tariffs from the US and then China responds there as well. Are you crazy? Look at what happened on Friday. It was down 10%. Well, yes, I am maybe a little bit crazy, but I'll show you that for a business like Alibaba, the reaction just doesn't make much sense. And you can actually view this yourself. This is again on FinChat, proud new sponsor of certain videos on the channel. FinChat is a stock research platform. We've seen it time and time again in my videos. But what's amazing about that platform is that it's one of the only ones, if not the only ones, that tracks company-specific metrics. You can find it here in the segments and KPIs one. Now, for Alibaba specifically, I am showing you here the various segments, business segments of that company. So we've got Taobao and Tmall Group, Alibaba International, which is AliExpress, Trendyol, and all of that, Cloud Intelligence Group, and then the logistics side of things. Now, what do you see here? What's the biggest segment? China commerce, right? So I highly doubt that the tariffs that's being put on a company like Alibaba from either, well, if it's tariffs from the United States or if it's retaliatory tariffs from China, that's going to impact the billion of Chinese that could be shopping on Alibaba, right? That could be shopping on Taobao and Tmall Group. Right? This segment is not going to be impacted in China since they're selling in China. Of course, the other segments here, international one, yeah, could be, although I don't know how big of a percent the US is when it comes to the international segment. I don't know, but that segment has definitely grown quite quickly in the last couple of years, so that's something we need to track. But remember, the majority of their business is still coming from China. Plus, you have another segment that is now reaccelerating, and that's the Cloud Intelligence Group. And so, yes, in my eyes, Alibaba still remains cheap. Now, of course, the state of the Chinese economy, that should be a concern. Tariffs, a bit less. The state of the Chinese economy, that should be a concern, which is why we're seeing this group here, right? The Taobao and Tmall Group not really grow that much for the last couple of years. So that should be the concern, but all in all, the business, the valuation here, well, to me, it still is very, very cheap. So all of that you can find here on FinChat. If you want to try it out, all new users will get 2 weeks of FinChat Pro for free. If you want to upgrade, you like it, you can use my link. You'll get 15% off. So thank you all for the support, especially those that have been using my link more recently. Continuing here on the Alibaba front, I mean, forward PE 11.8. Looking at the average here since 2016, that was closer to 20. So, of course, previously this company was growing faster than today, but today it's a bigger company. You also have cloud, you have the international segment that is growing faster. So, yeah, it still is cheap. If you look at the expectations for free cash flow in the next couple of years? Well, fiscal year 25, actually free cash flow is expected to take a big hit. And even in fiscal 26, it's expected to be down another 2.6%. Only in fiscal year 2027 is expected to, well, grow back up close to 30%. Now, zooming out, looking at gross profit margin, free cash flow margin, that has been coming down for many, many years now, right? Gross profit margin back here in 2027 was at 63%. We're now at 37.7%, which is a small rebound from 2023. Free cash flow margin is getting hit, but we also know that they're investing quite a lot in the business, investing in AI, in cloud infrastructure as well. So you have to take all of that into consideration. When you do that, you will still see that this is a tremendous business that is trading at quite a cheap price. Up next, company number 3, and that's Airbnb. Now, Airbnb has come down quite a lot already in the last couple of weeks, actually year to date. But since it became public, it's down over 26%. And yet since then, the business has become bigger and bigger. So what went wrong? Well, what went wrong is that when it went public, there was a lot of hype, extreme bull market, expensive stock, expensive IPO. So right now you're getting this company cheaper than before, yet it's much bigger than before. Market cap $66.2 billion, trailing 12 months PE of 25.9, next 12 months 24.6. Now the expected growth rates here are indeed low for a company like Airbnb, where you would have expected maybe higher growth than this. Revenue and EPS for the next 2 years or so, just 10%. Let's call it 10%. Of course, they expect to launch new businesses that they think should generate the company an additional $1 billion a year. Remains to be seen. There's going to be a big announcement, I believe, in May or in June for the summer release. I've talked about what I think Airbnb should be doing in the future: rewards program, advertising, integrations, partnerships. I mean, Gen AI Copilot that basically serves you as a concierge when you travel. Lots of opportunities out there. Now, year to date, as you look at the stock, year to date, stock is down around, 19% or so. Looking at price to free cash flow, because free cash flow for this business has been, quite astonishing. Price to free cash flow right now, forward sits at 18.5 times. The average, is sitting at 47.6. If you look at free cash flow growth for the next coming years, not much growth, although in 2027, that's expected to be above 14% growth year over year. Lots of changes in the short term with the business. Let's hope it does, reaccelerate growth, because right now, if you look at total nights and experience booked, the year over year growth rates have come down. Of course, 2020, they took a big hit, but then coming out of the pandemic, you see growth reaccelerate quite quickly. But since then, that has decelerated a little bit. So this is something that they need to be working on, looking at where they generate the majority of their revenue. Looking at 2024, it's North America, then Europe, Middle East, Africa. Then you've got Asia Pacific and Latin America, where they're growing a bit faster than the other more mature areas. Looking at the margin profile, as you can see, gross profit margin has actually become better. Last year, 83.1%. In 2021, I'm not really going to look here at 2020 because they got hit quite hard. 2021, 80.7%. Free cash flow margin, 2021, 38.6%. Last year, that was 40.7%. So this is a very, 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 very profitable business. And so just imagine what will happen when they manage to accelerate revenue growth. Of course, with all the investments, maybe free cash flow margin can get hit, will get hit in the short term. But if you can stay at around 40% or so and revenue starts to accelerate a little bit, well, you will, of course, generate more and more free cash flow, which means you can invest even more in the business, maybe buy back even more shares as well. So Airbnb at around $100, I like it way more at those prices than when it was at 150 or more. Last company for today, and that's Carnival, ticker symbol CCL. Yes, a cruise line, believe it or not. I've talked about cruise lines, Carnival, I've talked about Royal Caribbean, although Royal Caribbean has, beaten the market quite comfortably, I believe, in the last 2 years or so, and actually has beaten a lot of big tech performances as well. But Carnival is back at around $16 per share. Year to date, the stock is down over 34% or so, despite the business doing quite well, which is strange, but okay. Consumer sentiment, you might say that might hurt the cruise industry, etc., etc. Okay, maybe, but according to what they're seeing, 2026 bookings, they're not seeing that just yet or at all. Currently, Carnival has a market cap of $22 billion, valuation-wise, forward PE of 8.6 times with a trailing 12 months PE of 10.8 times. So yeah, it always is going to be trading at those low PEs, which makes sense. Free cash flow margin 7.8%. Expected revenue growth for the next 2 years, 4.1%, with EPS growing or expected to grow 22.5%. Now you're going to say, okay, they're becoming more profitable, free cash flow is growing, why aren't they paying a dividend yet? Well, they're not paying a dividend yet because they have to pay back their debt. They have a lot of debt because of that period during the pandemic, which makes total sense. Now here, if we look at the free cash flow growth rate or expected growth rate, we can see that in fiscal 25, that's expected to be up 78.6%. And then in fiscal 26, another 58.6% year-over-year growth, but then to drop 4.7% in fiscal 2027. Of course, if we go, let's say, into a recession, if consumer sentiment, consumer spending comes down drastically, that could hurt a company like Carnival. Although right now, as you will see, 2026 bookings have reached record levels, indicating sustained demand for future sailing. Now, of course, when we look at cruise businesses, you have, well, two ways that they generate revenue, right? You have the passenger ticket one, and you have the onboard and other revenue. Now, of course, the onboard revenue or the onboard spending can change, right? Can change maybe if things aren't looking great, but you're still wanting to go on a cruise. You will maybe go on the cruise, but you will spend less on board, which might impact that segment of the business. Now, another thing here that's good to see is that, well, if you look at occupancy, that has been now for 2 consecutive quarters at 103%. It has been above 100% actually for a while now. You're going to say, how is that possible? Over 100%? Well, you reach 100% when you have 2 people in one room. The moment you have an extra one, you get over that 100% mark, which is always great to see here, and look at that nice recovery since the lockdowns. Then if you look at the PCDs or the passenger cruise days, that has also increased for the last couple of quarters. And yes, it always is peaking here in the August quarter, which makes sense. And here, if you look at the margin profile, I'm of course going to look before the pandemic and after the pandemic. So before the pandemic, you can see gross profit margin 42.7%, and it peaked at 57.1%. Right now, we're at 54%. In 2024, we were at 53.5%, the fiscal years, that is. If we look at free cash flow margin, almost 10 years ago, 12.6%, and then that has actually come down. And now, as we've seen, we're at around 7% or so. Of course, they have invested quite a lot in new ships, so CapEx has increased a little bit, so that impacted free cash flow margin. But I mean, look at that nice recovery. Plus, if you look at total revenue, they're generating more revenue today than they did pre-pandemic. So it's really up to them. Keep the free cash flow profile or increase it, and that way you'll just generate more and more free cash flow, can pay back that debt faster than before, and then eventually you will probably pay a dividend. Now, of course, that said, all of these companies can, of course, get negatively impacted if that trade war turns into a full-blown global trade war, recession overall. Of course, that could impact those companies, maybe not the next quarter or the next 2 quarters, but probably for the guidance, maybe the back half of this year, maybe 2026, 2027 as well. So you have to take all of that into consideration, but I do want to talk about other companies other than semiconductors, big tech and fintech players, because yeah, there are a lot of opportunities out there. Some investors are maybe already overweight big tech or something like that. So I wanted to give you some other options as well. But yes, in the short term, do still expect some volatility. But hey, volatility might be the price you have to pay for long-term gains. Anyways, that's all I've got for you right now. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Do check out FinChat for 15% off, and I'll see you all in the next one. Bye-bye.